The rapid proliferation of COVID-19 has created challenges across the globe affecting nearly every sector. According to the USDA, the disruptive impacts of COVID-19 pandemic on U.S. agricultural system have been broad and varied. Tim, U.S. weather during the past few production months have been hot and dry over significant parts of the growing region. This has driven up option volatility. When looking at option volatility, the CVL index, which measures volatility in corn, reached levels not seen since the last drought back in 2012. Why is that important, and what are the key learnings?
What we've seen is D's corn rally from 383 back in November to a high of 638 in May. And at the same time, we witnessed implied volatility reach historical records. CVol, which is an index that measures 30-day implied volatility across all the strikes, not just at the money, actually reached a high of 56 the day before the USDA acreage report on June 30th. What CVol can do is help market participants get a better understanding of what options are telling them about the marketplace and understanding options pricing.
Yeah, I think it's very important to understand that CVol very carefully, Tim. Dave, early in the marketing year, China imported a record volume of soybeans from Brazil and Argentina. Fast forward, and the world's largest soybean supplier is now facing a new planting season. With the current supply situation in Brazil extremely tight, what does this mean for the U.S. soybean market?
Yes, Dan, as we make the normal seasonal shift to be buying U.S. beans from the tail end of our harvest, we do see China behind the curve. But when you look at historical data, we are in the beginning of a big ramp up, and for them to catch up, they have had a lot of on and off activity in their crushing industry. Part of that's been due to shipping backups, energy prices, Delta variant. And so what happens is the demand appears as if it's been crushed and their imports slow down. But 2 years ago, they did 98.5 million metric tons. And then this year, they're projected at 99, and we expect 101 million metric tons in the coming year. And they are behind. They're at only 12 million metric tons purchased now versus a normal 17 million metric tons. So I believe it will catch up. Demand is there. Economic data is not necessarily going to change eating habits.
And Tim, for grain traders, this is the second harvest season in a pandemic, and the demand for U.S. grain this year has been historically large. What is the data in the short-term options telling us about the marketplace here today?
Well, Dan, we've had short-term options for quite some time, and they've always been part of a lot of people's marketing program. But what we've really see the market do this year is embrace these products. Now, we have two types of short-term options. We have weekly options and we have short-dated new crop options. Weekly options, we're seeing market participants use them sort of as event insurance. I have a report coming up, I want some protection, so let's buy a weekly option. It's fairly inexpensive because the time's only a week. Short-dated new crop options, we're seeing more producers and longer-term traders use those. What they essentially do is give you an option against D's futures or November futures in the case of soybeans, but because they expire sooner, the cost is less and the tenor is less. What's really stood out to us is that 20% of all corn options were done in the form of short-term options. And that's really showing how the market is embracing these tools, particularly in a time when there is high volatility and standard option premiums are pretty substantial.
David, when it comes to the USDA supply demand data, what is your key takeaway for grain traders?
Well, this year, I think mirrors 05-06. When you have bad weather in July, the USDA took note of that, and with their models, dramatically lowered their yield projections. And then as we got into more favorable August weather, the USDA thinks there was resiliency, and there was, and then they began to raise the yield, and I think we'll be at a 51.1 yield for soybeans. But I also think that we're going to have just minor adjustments from this going forward.
Harvest season is the busiest time of the year, and this year marks another year of special challenges to watch. Uncertainty with the Delta variant, inflation concern, and strength of the U.S. dollar.